Hello guys, welcome to another video. This is your financial management tutor Sir Uzair Awan, and in today's video we'll be covering a past paper question related to the area business finance and cost of capital. And the name of the question is Zeddemore Company. So first of all, let's read the requirement of the question. The question says using the capital asset pricing model, calculate Zeddemore Company's current cost of equity and a project specific cost of equity suitable for the new venture. So basically you can see that there are two requirements. First of all, you have to calculate the current cost of equity and then the project specific cost of equity. Okay. So let's read the question first. The question says Zeddemore Company is a listed company in the house construction industry. Over the past 5 years, results have been disappointed, and as a result, the share price has fallen from a high of 3.50 per share 5 years ago to only $1.05 per share today. So that's a very significant drop in the share price from 3.50 to 1.05 in just a span of 5 years, right? They say that this deterioration in the performance and share price has been accompanied by an increase in financial gearing to a high level. All right. Now, after that, we have been given the Zeddemore company's capital structure that we can just ignore for now. We'll come back to this once we, start with our calculation. But for now, just skip this. Then you can see we have been given Zeddemore company's loan note market value, and then we have been told that the equity beta is 2.3. Okay. After that, they are telling us about the new venture. It says to improve performance, Zeddemore company is considering the construction of a commercial properties such as office blocks and industrial complexes, which is very good. So they are now diversifying themselves into new areas which they have not explored before, right? This is a new activity for Zeddemore company, and it is expected that the risk involved will be different from its current activity. Now this line is very important. Why? Because they are saying that this activity is new for Zeddemore company. They have not invested or undertaken this kind of projects before, right? And the risk involved will also be different from its current activity. So if you guys remember, when we were taking the classes of CAPM, when we were studying the capital asset pricing model, I told you guys in the class that it is preferred to use capital asset pricing model where you are doing investment in a new industry, in an industry that you have not invested before. Then the CAPM model is much more preferable to calculate your return, because it takes risk also into account, and risk is very important when you are investing in new projects, new industry, the kind of investment you have not done before any time, right? So if you're doing a new investment, then CAPM is preferred, right? So that is one thing we should keep in mind while we're reading this line. Now it says the financial director has proposed that a project specific discount rate like the CAPM should be used to appraise the new venture. So yes, the financial director is correct. He's right. But the commercial director does not believe this is necessary. So commercial director is not right, something that we know from our knowledge that financial director is correct to say that you should use a project specific discount rate like the CPM, right? That's also a project specific discount rate to appraise the new venture. So this guy is right, but this guy, the commercial director, he thinks that it's not necessary, which is absolutely wrong, because it is necessary. You are going into a new industry, you are investing in a project, you are undertaking a project that you have not done before. So that comes with a lot of risk. So you need to take risk into account, and the only valid method which take risk into account is the CAPM method, right? Then it says Winston Commercial Properties Company, the WCP, undertakes commercial construction projects similar to those being considered by Zeddemore Company. So that means this Winston Commercial Property is going to act as a proxy company in this question, right? Because you guys know we need the proxy company for de-gearing and re-gearing and all this stuff, right? So here is the proxy company given to us in the last paragraph. Then it says both companies pay tax at 20%, the risk-free rate is 4%, and the expected return on the market portfolio is 10%. Now you guys know that we need all these information to calculate our CAPM, right? To calculate our return through the CAPM method, correct? So remember that this data that they have given in the last line is not related to the new venture, okay? It's not related to the new venture. It's a general thing. They're saying both companies pay tax at 20%, risk-free rate is 4%, and expected return on the market portfolio is 10%. So it's a general thing, okay? So let's start with a solution now. We know the requirement. What's the first requirement? That we have to calculate the current cost of equity, current cost of equity. Now, what does it mean by current cost of equity? It means before entering this new venture, okay? So we'll be using the data before entering the new venture to calculate our current cost of equity right now. What's the cost of equity before entering the new venture, right? That's your current cost of equity. So let's calculate CAPM. And you guys know the formula, right? It's going to be 4% plus bracket open beta equity. You can see that over here it says that Zeddemore company's equity beta is 2.3. So that's your current equity beta, correct? Then again you're going to open the bracket. Why? Because now you're going to subtract the market return from the risk-free return, right? And where is the market return given to us? In the very last line you can see risk-free rate was 4%. That's why I've taken 4 over here, right? And the expected return on the market portfolio is 10%. So I'm just going to do 10 minus 4, okay? Bracket close, and then the other bracket close. Don't forget to put a multiplication sign with this 2.3 so that you can get a valid answer. So 4 plus 2.3, the equity beta, times the return from the market, which was 10%, minus the risk-free return, which is 4%. So this is the formula that we use to calculate our cost of equity using the CAPM method, right? So now I'm just going to press enter, and you guys can see that I have 17.8%. So 17.8% is my current cost of equity, okay? And anybody who wants to see the formula again, you can see it from here. Again, it's a very simple formula. RF, which is the return, risk-free return, 4%, plus equity beta 2.3, given over here. Zeddemore company's equity beta is 2.3, right? Times the market return, which was 10%, given in the last line, minus the risk-free return, which is 4%. And then you just make sure that the brackets are in place so that you get a fair value, right? So after, solving this, I get my 17.8% as the answer, as the current cost of equity. Okay, so my current cost of equity is 17.8. Alright, now I'm going to calculate the project specific cost of equity. So for project specific cost of equity, we'll be using our Winston proxy company. Remember that. Why? Because you guys know we need the beta equity of our company, and for that we need the beta asset of a proxy company, right? That's how we studied it, right? That you always try to use a proxy company to get its beta asset. Once you get its beta asset, then you do the re-gearing to put your financial risk, your company's financial risk, into that beta asset, and then you get a beta equity based on your company, and that is what you use for your CAPM, correct? So first of all, I always write my data so that it makes my working easier, right? So I will need the beta equity to convert it into beta asset first, right? That's what we call the de-gearing, right? Where you convert the beta equity of the proxy company into beta asset. You remove the financial risk from the proxy company, right? So its beta equity right now of Winston company is how much? You can read the paragraph where they were talking about the Winston Commercial Property Company. It says that WCP has an equity beta of 1.25, right? So I'm going to come over here and I'm going to write 1.25. That's my beta equity, okay? And then what I need is the VE, which is my market value of equity. And how do you calculate the market value of equity? It's very simple. You take the number of shares and multiply it with the market price, right? So let's see. It says over here that WCP has $100 million of ordinary shares in issue, currently quoted at 2.60 per $1 nominal value. So if I take out the number of shares, it's going to be 100 million divided by 1. That's going to give me 100 million shares, correct? So I have 100 million shares and each one is quoted at 2.60. So that means 100 into 2.6. So that is 260, okay? So my market value of equity comes out to be 260, okay? Now I'm going to calculate my market value of debt. How do you calculate the market value of debt? Let's see. So it says the company also has, just a second, okay, yeah. So the company also has $110 million of loan note in issue, currently quoted at $96 per $100 nominal value. So I'm going to divide 110 with 100 so I can have the number of loan notes, and then I can multiply with 96, which is the market value. So I can get the actual market value of the debt, okay? So like I said, 110, and first of all, let me just make a bracket. So I can tell Excel that you need to divide first, right? So 110 divided by 100. In that way, I will get the number of loan notes, and then I'm going to times it by 96, which is the market value of loan note. So in that way, I'm going to get the market value of debt, which is 105.6. Okay. So you can see that I have my market value of debt. And now what I'm going to do after having all this information, now I'm going to work the de-gearing, right? I'm going to start with the de-gearing. All right. So de-gearing, you guys know that what do we need for de-gearing? We need VE, which you guys can see I have already calculated at top, right? I need VD, which is the market value of debt, times 1 minus tax, right? So I'm just going to select my market value of debt that I just calculated, and I'm going to times it by 1 minus tax. What's the tax rate? If you guys read the last line, it says both companies pay tax at 20%. So tax rate is 20%. Okay. So here is my market value of debt after tax. Okay. And then what I'll do, I need the beta equity, right? So beta equity is 1.25. Now I can easily calculate my beta asset with the help of the formula of beta asset. And what's the formula? In case you guys haven't memorized it till yet, though you should have memorized till yet, but if you haven't, then this is the formula for beta asset. And as you guys know that in 99% of the question, like I told you during my lecture, the BD is not given to you. The question is silent about the BD, so you just assume BD is 0. And if BD is 0, this entire fraction that you see on the right, it becomes 0, right? So this fraction only on the left is relevant for us. And what does it say? It says that take the market value of equity divided by market value of equity plus market value of debt after tax into beta equity, right? So that's our formula right there. And I'm going to just put this to the side again. And now let's calculate it. So like the formula said, take VE first, then divide it by VE plus the market value of debt after tax, right? And just see how I am placing the brackets so that I can get a correct value, because first you need to tell Excel that you need to add these denominator, and then you need to divide them both and then times it by the beta equity. Okay, so you can see I have 0.94 as my beta asset. Okay, so that's my beta asset, 0.94. And now after doing the de-gearing, you guys know that we have the beta asset. Now we are going to use this beta asset and insert our financial risk into it so that we can get our beta equity, right? And that is what we call the re-gearing. Okay, now we'll be doing the re-gearing, and for re-gearing, you guys know that we need to, calculate the market value of equity, market value of debt after tax of Zeddemore company. This was for the proxy company, right? But now we are going to do the re-gearing, which means we are going to insert the financial risk of Zeddemore company into this beta asset, right? So we can calculate the beta equity of Zeddemore company, correct? So for that, let me just calculate the market value of equity for Zeddemore company, and obviously we'll be using this data over here, the capital structure which was given to us, right? So it says that they have 40 million shares at 0.50 per share, right? So $40 million share at 0.50 per share. So first of all, I'm going to divide these two because you guys know we need the number of shares. So 40 divided by 0.50, bracket close. Okay, and then I'm going to times it by the market value of share, which should be written somewhere over here. So that is over here, as you guys can see that it is now at 1.05. Previously it was 3.50, but that was 5 years ago. Now it's at 1.05. So 1.05, and that's my value of equity, market value of equity for Zeddemore company. Now I'm going to calculate the value of debt after tax. Okay, so for that, what we are told is that for debt, the Zeddemore company has 6.5% irredeemable loan notes, $100 per loan note nominal value, and the total value is $250 million, right? And the loan note are being traded at 65. Okay, so what I'm going to do, first of all, forget about after tax, let's just calculate the market value of debt first. Okay, so first of all, I will calculate the number of loan notes. So for that, I have to divide 250 with $100, which is the nominal value, right? In that way, I'll have my number of loan notes. Then I multiply with the market price, which is given over here. Zeddemore Company's loan note are quoted at 65. Okay, so you guys can see that 162.5 market value of bank loan, because bank loan cannot be traded, right? So you just take the book value of loan note as your market value, which means that as far as bank loan is concerned, right, you are just going to take 20. Okay, so that means that your value of debt would be the market value of irredeemable loan plus the bank loan, right? So that's 182.5. So that's your VD. Okay, that's your VD. And let's just say that this is irredeemable loan notes. Okay, all right, so this is the market value of irredeemable loan note, 162.5. Then we had the bank loan. Okay, remember that we just took the book value of bank loan as the market value, because bank loan cannot be traded in the market, so its book value is equal to the market value. Okay, and you just add them both together because they both are debt instruments, right? So you got your market value of debt as 182.5. Okay, now we have the value of equity, market value of equity, then we have the market value of debt. And now what we will do, we will obviously try to calculate the after tax, because that is what we need in the calculation, right? So once I have calculated my market value of debt, I'm just going to take that, I'm going to times it by 1 minus t. You guys know that the tax was 20%, right? So it comes out to be 146. That's my VD times 1 minus t, which means the market value of debt after tax. Okay, and now finally we'll be calculating the beta equity, as you guys know. So how do you calculate the beta equity? Now look at this formula of beta asset, right? So you will have to do the reverse working. Okay, and like I said, that this fraction on the right hand side, you just ignore this because this is the BD is not given to us, right? So this is just nullified. The only thing we are concerned with is the formula on the left hand side, right? So in order to calculate the beta equity, I will need to first send this denominator, which is going to go to the other side. So it becomes beta assets times this entire denominator, right? And then this value of equity will go to the other side, so it will divide. The denominator will multiply, whereas the numerator will divide, right? Simple maths. Okay, and that is going to be equal to beta equity. Okay, so that's how our formula is going to look like. So let's say, what do we need first? We need the beta asset, right? And what was the beta asset that we got? The beta asset that we got was 0.94. Okay, so that's our beta asset. As you guys can see, I took beta asset first. Okay, wait a second. So is equals to the beta asset value. Okay, and then like I said, you have to multiply this with the denominator, because the denominator will go to the other side. Over here it's dividing, when it goes to the other side it multiplies, right? And what's the denominator? VE plus VD 1 minus D. Okay, so that means VE 84 plus VD times 1 minus tax, which is this value over here, right? And then I'm going to close the bracket. All right, so that's the first thing. And now we are going to form another bracket between these, so that we can tell the Excel that first you have to add these two values, then multiply it with n15, and then this VE, which is in the numerator, will go to the other side as well, because we need the beta equity. So we need to send this value of equity to the other side, and it's over here it's in the numerator, so when it goes to the other side it divides basically, right? So we're going to write divide by the market value of equity, which is 84. Okay, so this is how it should look like. And once I do that, I get my beta equity as 2.58. Okay, and that is my beta equity. And now finally I'm going to calculate my CAPM. So for that, I will have my risk-free rate, which is 4%, right? Plus bracket open the beta equity that I just calculated, times bracket open the market rate, which is 10%, minus the risk-free rate, which is 4%. And just a second, we do not put the percentage sign. Okay, so 4% plus the beta equity times the market rate minus the risk-free rate, right? And I think that is it. Right now I'm going to press enter, and my CAPM comes out to be 19.5%, and that is the answer. Okay, that is our project specific cost of equity suitable for the new venture. So this was the requirement of the first one, where you had to calculate the current cost of equity, which came out to be 17.8. And now this one is our project specific cost of equity, which came out to be 19.50. And this is the entire solution in front of you, right? Okay, so let's just quickly take an overview of this question. So basically, first of all, we had to calculate the current cost of equity, which was before taking the investment. So we did that and it came out to be 17.8. Then the company, Zeddemore company, tried to enter a new venture. So for that, we had to calculate a project specific cost of equity, just like we learned in our lectures, right? So for that, you guys know that we always need a proxy company from the same industry that we are trying to invest in, right? So the company in this question given to us was Winston Company, and we took it as proxy. And like always, we always try to take out the beta asset of the proxy company by doing something called as the degearing, right? So we are always given the beta equity, which was also given to us in this question, and we do not need beta equity. We need the beta asset because beta equity also has the financial risk. So we need to get rid of that financial risk, right? So once we get rid of the financial risk, then we got our beta asset with the help of the formula of the beta asset, which is this one, right? Something that you guys should have memorized till now, okay? And then once we got our beta asset, we know that okay, now this is the beta asset, which is after removing the financial risk of Winston proxy company, because financial risk is different from all the companies, right? So this process through which we remove the financial risk of the proxy company is called degearing, right? And after degearing, we get something called as the beta asset, which is 0.94, which is basically the business risk of this company. Then after taking the business risk of Winston company, we try to re-gear it by inserting our financial risk, right? And what is our financial risk? It's basically the interest that we have to pay on the loan notes and on the bank loan, right? So we took that into account, and after that we got our beta equity, which was after taking the financial risk into account as 2.58, and based on this beta equity we calculated our project specific cost of equity, which came out to be as 19.50 by using the CAPM method. Okay, so with that, the objective of today's class has been met, and I'm gonna meet you guys with a new video with a new chapter. Till then, take care, have a great day, goodbye.